Canada's real estate market has already crashed by the textbook definition, and most Canadians don't even realize it yet. We're talking 21% down from the 2022 peak, the largest correction since the early 1990s. Today, three creators tell us why that number might still have some room to run. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Today we're doing a housing market reality check with analysis from three creators who are painting a very different picture than what you might be hearing elsewhere. Ron Butler breaks down why the crash people are waiting for has already happened. Steve Saretsky examined the fundamental weaknesses still plaguing Vancouver and Toronto markets, despite seasonal improvements, and Market Mania revealed how the Canadian dollar has been quietly losing ground against major currencies, while most Canadians weren't paying attention. Let's start with Ron Butler's perspective on where we actually stand. Ron Butler made a compelling case that Canada's real estate crash isn't coming, it's already here. His argument centers on the standard definition of a market crash, a 25% or more decline from peak to trough. Butler points to Durham Region as his Exhibit A, which he puts at 26% down since March 2022, just past the textbook crash threshold. He also highlights individual properties in Brampton, Durham, and Niagara that have dropped 50% from peak, which he describes as the worst bid-up situations from the market's frenzied top. To be clear, the 26% figure is Butler's own calculation. The national MLS benchmark is down 21% from peak, with Ontario markets generally running steeper declines than the national average, which makes his regional number directionally plausible. What's notable is his forward-looking call. He expects another 5 to 10% decline in Durham within this year. His advice for buyers is straightforward: wait. He sees the market remaining difficult for the next 12 months, with continued deterioration beyond where we are now. Butler's argument is essentially that the crash already happened behind closed doors, but waiting for what exactly? Steve Saretsky's May update gives us the structural reasons why the recovery might be further away than most people expect. Steve Saretsky's May 2026 market update reveals some troubling fundamentals beneath any seasonal improvements. In Vancouver, sales are tracking exactly the same as 2025, which is a 25-year low in annual home sales, indicating the weakness isn't temporary. In Toronto, he's seeing a split market, bidding wars in central urban areas while suburban markets stay sluggish, with low-rise prices down 6% and condos down 7 to 8%. The bond market story is where things get interesting for Canadian investors. Rate cut expectations have completely reversed. Markets that were pricing in multiple Bank of Canada cuts are now pricing in potential consecutive increases, with bond yields 50 basis points above last year. The BOC held again in late April, caught between a contracting economy and a new inflation threat from the oil price shock. Saretsky also flags the supply shock as structurally different from the COVID demand shock. There are no excess savings, no pent-up demand, no labor pricing power this time. The tailwinds that fueled the 2021 bounce simply don't exist. On mortgage stress, Brampton deserves its own mention here. Brampton's 90-day mortgage delinquency rate hit 0.6%, more than double the national average of 0.26%. To put that in perspective, Brampton's delinquency rate was 0.06% in 2019. That's a tenfold increase in 6 years, driven by buyers who purchased near the 2022 peak and are now renewing large mortgages at significantly higher rates with less equity than expected. On the supply side, Saretsky flags CMHC's MLI Select program, which allows developers to build rental apartments with as little as 5% equity down and amortizations up to 50 years. The program is flooding the market with new purpose-built rental supply, which is good for renters long-term, but creates real short-term oversupply risk in some markets. Saretsky is focused on what's happening inside Canadian borders. Market Mania zoomed out, and the picture they found at the currency level is what ties all of this together. Market Mania highlighted what they describe as a quiet but significant weakening of the Canadian dollar that's hitting specific groups of Canadians hard. Their 5-year analysis shows the loonie down roughly 11% against the US dollar, 23% against the Mexican peso, numbers they say are particularly painful for Canadian retirees living abroad on fixed incomes. These are Market Mania's own calculations, so treat them as their framework rather than the official data. One important caveat worth raising in the near term: the loonie has actually strengthened against the US dollar, recovering from its late March lows as oil prices surged on the Strait of Hormuz disruption. Canada is a major oil producer, and higher crude prices help our trade balance. But Market Mania's argument isn't about last month, it's about the structural 5-year trend that one commodity spike doesn't fix. They also highlight that Canadian homeowners now owe over $170 billion in home equity lines of credit, with average balances around $70,000. On inflation, their read is that bond markets are signaling higher structural inflation ahead, consistent with what the BOC is now navigating, with smart money treating elevated long-term bond yields not as temporary disruption, but as the new baseline. Market Mania's broader framing, only the top 20% of Canadians are seeing net worth growth right now, largely through stock portfolios at all-time highs, while falling house prices are doing real damage to everyone else's balance sheet. So, a crashed housing market by the numbers, a mortgage stress crisis concentrated in specific Ontario communities, a supply shock with none of the demand drivers that fueled previous recoveries, and a currency that has lost significant ground over the past 5 years. Let's try to make sense of what it all means. What emerges from today's analysis is a picture of multiple overlapping crises that most Canadians aren't fully grasping. Ron Butler and Steve Saretsky both document a housing market that has already experienced crash-level declines. Butler with Durham at 26%, and Saretsky showing Vancouver and Toronto sales at multi-decade lows. Market Mania adds the currency dimension, showing how structural loonie weakness compounds these domestic challenges for anyone with cross-border exposure. Both Saretsky and Market Mania make the same underlying point from different angles. This isn't a temporary dislocation. The structural conditions that drove the 2021 boom, excess savings, suppressed rates, pent-up demand, simply no longer exist. Saretsky emphasizes this supply shock is different in kind, not just in degree. Market Mania argues the global economy has changed completely since 2020, and many consumers are frozen, waiting for conditions that aren't coming back. The question for Canadian investors isn't simply whether to buy real estate, it's whether the assumptions behind that decision, about prices, about rates, about currency, about what a normal market looks like, are from 2019 or 2026. Those are two very different sets of numbers. Well, that's your Daily Brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss our next brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.